Hello Business 385. This video demonstrates how cost volume profit analysis can be used to determine the amount of fixed costs and variable costs that are embedded in published financial statements. The example that we're using is problem 334 from the Cost Accounting textbook, Chapter 3. In this case, the company of interest is the Netflix Corporation for the years 2010 and 2009, and these represent values that are in thousands of dollars. And so this value for revenues for 2010 really represents $2.16 billion, and this value for 2009 represents $1.67 billion. The task that we have is to develop a cost estimation equation for the annual cost of revenues and operating expenses for Netflix. In order to do that, we first need to break out the amount of variable costs and fixed costs that are embedded in this $1.878 billion of total costs. Here's how we do it. We know that total costs represent $1.78 billion, but somehow we need to get the variable component. Here's what we infer from cost volume profit analysis. We know that if any cost changes, in this case the difference between $1.878 billion and $1.478 billion, which is about $400 million, the only reason that comes about is mostly because of the variable costs in the cost structure. So if there is any change in cost, it comes about because of the variable cost. So this change in cost that we have in the numerator of the fraction is due to the variable cost. Now, what is the cost driver? The cost driver is the amount of sales that the company has. If the company sells more units or increases the selling price, that causes revenue to go up. So we are going to use revenues as the cost driver, and the change in revenue, a surrogate for volume, will be the driver for the change in cost. So we will take the change in cost, which in this case is $400,654,000, and divide it by the change in revenues, $492,356,000. And when we do that, we have a variable cost percent of 0.8137 that we can insert in our little table to manage fixed and variable costs. Now, here's what we can use. This 0.813%, when multiplied by the cost driver, in this case revenues for 2010, $2,162,625, multiplied by 0.8137, will produce variable costs of $1,759,728. So what this says is $1.7 billion of the $1.878 billion is variable cost. Variable cost plus fixed cost equal total cost. So total cost less variable cost will give us the fixed costs. So taking the $1,878,984,000 of total costs and deducting the variable cost of $1,759,728, variable cost will produce the fixed cost of $119,256. This amount is what we can insert in the table to indicate what the fixed costs would be. And we can use this relationship to figure the break-even, which is the next point. Break-even says that we want profit of $0, and in order to break even, we need to have profit just big enough to cover all the fixed costs. So the target contribution margin that we want would be $119,256,000. We get that by knowing that the contribution each dollar of sales gives us is 18.63%. So in other words, for every $1 of sales, each dollar of those sales produces 18.63 cents to contributing to covering fixed costs, and in this case, zero profit. So the break even in this example would be the target contribution margin that's necessary for the desired level of profit. Again, it's zero profit because we're at a break even, divided by the contribution margin ratio, which is 0.1863. Running the numbers, 119,256,000 divided by 0.1863 is going to give us $640,129,000 in order to break even. So the sales that we would enter as the break even, 640,129, would be indicated if the revenues, 81.37% of that would be the variable cost, so multiplying sales by 0.8137 produces variable costs of $520,873. And if we want to check this, let's deduct 520 from 640. So 640,129 of sales less 520,873 of variable costs does in fact give us the contribution margin that we want, 119,256. There you have it. Give this a shot.